All right, so in this video, I'm going to talk a little bit about how to quantify leverage. So first, I'm going to talk about operating leverage and how to quantify operating leverage. So operating leverage is the extent to which fixed costs are used in a firm's operations. And the result of that is because there are certain fixed costs that a firm may have, if sales goes up by, say, 10%, some of the costs don't change, they're fixed, which means the operating income or EBIT could actually go up by more than the 10%. Or if sales declines by 10%, the EBIT could go down by more than 10%, basically because those costs stay there and erode more of, on a proportionate basis, the money that's flowing down to the operating income. So to quantify that and do something called a degree of operating leverage, there are a couple different ways that this can be done. So if you have access to information about what constitutes a variable cost and a fixed cost for a company, then you can actually calculate it directly with just 1 year's worth of information by looking at sales minus variable costs over sales minus variable costs minus fixed costs. And this is going to tell you basically the relationship and what it's quantifying here is basically for a given change in sales, what's the change in EBIT? So if I get a degree of operating leverage of 5, for every 1% change in sales, I get a 5% change in EBIT. So that's the idea. So if I have enough information about what's a variable cost and what's a fixed cost for a year's worth of financial statements, then I can actually calculate that. Now, more commonly, if you're on the outside looking in for a company, you don't necessarily see on an income statement things tagged explicitly as fixed costs and variable costs. But what you can do is across a couple of years, you can look at the percent change in sales and the percent change in EBIT and calculate it that way. So if I see that sales went up by 10% in one particular year, from 1 year to the next, and then in that same period of time, EBIT or operating income went up by, say, 15%, then I would take 15% over 10%. My degree of operating leverage would be 1.5. And what that would mean is that basically for every 1% increase in sales, I expect a 1.5% increase in EBIT. For every 1% decrease in sales, I would expect a 1.5% decrease in EBIT. And so I basically am quantifying with that 1.5, that relationship between sales and the EBIT. Now, for the degree of financial leverage, if I, again, have access to enough information, I could use sales minus variable cost minus fixed cost over sales minus variable cost minus fixed cost minus interest. And that would give me my calculation. But again, most of the time on the outside looking in, I don't have enough information to know exactly what's a variable cost or a fixed cost if I'm just looking at the standard SEC financial statements, basically. But what I can do is if I have SEC financial statements or financial statements for other sources, what I can do is I can look at that percentage change from 1 year to the next. And I can compare the percentage change in EBIT over the percentage change in net income. So if I kind of continue on with my example, so let's say I had a 1.5% change in EBIT, but I had a 3% change in net income. So I would have a 3% change in net income over 1.5% change in EBIT. So if that was my situation, then I would have 3 over 1.5, which would be 2. And so that would mean I would have a degree of financial leverage of 2. And what that is saying is for every 1% increase in EBIT, I would expect a 2% increase in net income. So my net income is going up twice as fast as my change in EBIT. Now, it's worth noting that if I have a degree of financial leverage and a degree of operating leverage, I can actually calculate a degree of combined leverage, which is where I actually just multiply the two. So in the example, I had a 1.5 degree of operating leverage. I had a 2 degree of financial leverage. So if I would take 2 times 1.5, my degree of combined leverage would be 3. Or I could express that as my percent change in net income in my example was 3. My percent change in sales was 1. So I had a 1% change in sales. I had a 3% change in net income. So 3% change in net income over 1% change in sales gave me a degree of combined leverage of 3. And my degree of operating leverage was 1.5. My degree of financial leverage was 2. 2 times 1.5 was 3. And again, if I had enough information about what was the fixed cost, what was the variable cost, I could directly calculate it with 1 year with sales minus variable costs over sales minus variable cost minus fixed cost minus interest. And that should give me the same result. And that would be a way that I could quantify the amount of leverage I have. And the reason why I might want to know that is if I'm expecting a given change in sales, and if I know what the degree of operating leverage is, and I know what the degree of financial leverage is, it gives me a better way of predicting and projecting out what would I expect to occur with my net income. So instead of just saying sales are going to go up by 10%, net income is going to go up by 10%, now I can actually say, all right, if I think sales are going to go up by 10%, and I think my degree of combined leverage is 3, I actually think that net income is going to go up by 30%. And that would be helpful when making projections and forecasts and creating expectations and so forth. All right, hopefully this little video about kind of quantifying leverage has been helpful. Thank you so much for watching and have a great day.